Hello, and welcome to day 2 of the Momentum Investments Annual Investment Matters Conference. Now, today's subject matter is all about alternative investments. Now, this is an area that has been growing and gathering more and more interest as we've heard about the need for infrastructure investments from the President, Cyril Ramaphosa, and the role of private capital and retirement funds to access this new opportunity set. Today, we'll showcase a broad range of thinking and approaches that affect the alternative investment landscape. Now, there's been a lot of attention and focus around responsible investing, environmental, social, and governance, or ESG issues, as well as the United Nations Sustainable Development Goals. The team from Momentum will show us how they use investments to make a positive impact, not only on the environment, but on society overall. And this is where your capital not only gains a return, but it's also able to have a positive impact on our lives and that of future generations. It's all about putting our money in areas that drive and encourage a greater good that we can all experience. Coming back to matters of a professional nature, we applied for Continuous Professional Development, or CPD points. So please be sure to watch the full sessions throughout the conference and add your ID or FSP number to the CPD section. So we will be sure to verify your attendance and viewership of the program and offering we have today. The CPD certificates will be mailed to you after the Financial Planning Institute's accreditation has been finalized. But coming back to what we hope to interact with you and engage with you, we would like to encourage you to post your questions to the speakers in the questions and answers section. And you're more than welcome to make use of the chat function to also say hello to the speakers and interact and network as you would with fellow attendees. Sonja Saunderson is the Chief Investment Officer at Momentum Investments, and we'll start today by looking at some of the aspects and trends she is overseeing within the alternative investment landscape. As a strong female voice in the investment arena, Sonja is well positioned to provide insights in how to develop and nurture this exciting area of investment management.
Thank you, Gugu. Alternative investments have moved from being on the periphery of the global investment landscape into now really being in the mainstream. In just 15 years to 2018, alternative investments grew from 6% to 12%, or $13.4 trillion of the global market. And it's expected to grow to 24% by 2025. Staggering numbers. Although we are lagging this trend in South Africa, the need for diversification, a much more favorable legislative environment, as well as the presidential push to promote infrastructure investments to assist in growing the local economy, are all tailwinds in fast-tracking the same growth locally. Yesterday you heard from our asset management team on how they see the investment opportunities unfolding in traditional asset classes, and how our responsible investing approach in these asset classes will help us navigate for the future. Tomorrow, you will hear from our multi-asset class solutions team, and they will give you their perspective on how they are empowering the future with investments that they are making and service providers that they are dealing with from a local and a global perspective. But today, the emphasis is on our alternatives business and how the future can be shaped through our investment and innovation in non-traditional asset classes. Maybe for some background, for those of you that don't know it, Momentum Alternative Investments has a rich history, many firsts, lots of innovation, and it keeps evolving as newer thought leadership comes to the fore. It was actually started in 2007 already, launching with a hedge fund program that was built off the expertise and processes from overseas skills and mirroring global best practice. We were the first with our groundbreaking hedge fund replication strategies, which have continued to start a new chapter for affordable hedge fund strategies in South Africa. Over time, we further strengthened our offering, which today spans a direct offering, a fund-of-fund offering, as well as a hybrid offering that covers the whole capital structure. That way, we cover strategies that will aid investors from a risk, return, and diversification perspective, and that can complement traditional asset classes, and with a focus on a wider investment menu, offering superior risk-adjusted returns that are sought after in a lower growth environment that we're in right now. The investment strategies in this space lends itself to improving client outcomes and enables us to sculpt payoff profiles to target different investor requirements and profiles. The strategies range from high-yield portfolios to local as well as global private equity portfolios to add to the menu of options for our clients. As President Ramaphosa urged the investments and savings industry to assist the government in rebuilding the economy, we responded by focusing our efforts and targeting investment opportunities that are impactful and sustainable for the long term, and also having a lasting positive effect on our economy, society, and the environment. We are convinced that financial markets do have the power to promote sustainable business practices and address local and global social and environmental concerns that may jeopardize a prosperous future. It is this conviction that guides our efforts to mobilize capital towards creating positive impact. Our new impact portfolios are uniquely positioned to drive impact in exactly the same positive way. It fits into our sustainable long-term investment philosophy, and it supports our efforts to reach our chosen sustainable development goals. This all forms part of our integrated approach to and sustainable investing for our clients. These latest additions to our portfolio ranges enable us to deliver a compelling financial return on investments, while at the same time also having a positive social environmental benefit and impact. For us, a key defining characteristic on impact investing is its expressly stated intentionality. Impact investing has, by design, an intentional impact on either the society, the environment, or both. This key characteristic and the ability to measure the impact differentiates our impact investing offerings from all other investment types in the market. When viewed this way, impact investing is a universal term as it can be applied to all investment types and all asset classes and can also be measured accordingly. Please be on the lookout for our impact scoring methodology that we will be rolling out towards the end of the year. And please also do take a look at how we think about the intentionality of impact investing and how the integration of responsible investing practices in our alternative investment offering is making a difference. All of this is in the latest issue of our Mindfields research publication, as well as our stewardship report. Our portfolio managers in the alternative investment space have been around pretty much since the inception of the business. And in today's session, they will demonstrate to you how we think about the leadership role we play as stewards to our clients' investments and how we invest to optimize financial, social, and environmental outcomes. I do hope that you enjoy this session with us.
Muklatsi Mutlanyana is the head of alternative investments at Momentum Investments and the champion of nurturing and growing the alternative investments landscape. Now, the area of infrastructure investing and the effect these investments can have, especially when considered through the lens of responsible investing and sustainable development goals, are unpacked. Muklatsi will demonstrate how real and tangible these investments can be to drive a real impact and change while achieving meaningful returns for clients.
Thank you, Gugu. Today we are going to be discussing sustainable investing and specifically looking at impact investing. Impact investing is a reminder that the economy is a wholly owned subsidiary of nature and not the other way around. Sustainable investing is an attempt to calculate the true contribution of natural capital to our economy. The World Economic Forum says that more than half of the world's GDP is dependent on nature, for example, the provision of food, fiber, and fuel. Also, 3 of the 4 bites of food that we eat depend on animal pollination. If we start to place a value on the services of nature, it will be truly transformational to the valuation and prospects of our investments and the quality of our retirement. As the world continues to grapple with the economic and environmental challenges, asset owners are looking for ways of deploying their capital to generate financial returns in a way that contributes to these efforts. KPMG's 2020 Fund Survey shows that institutional investors are the biggest drivers of demand for impact-focused funds. According to the GIN, the Global Impact Investing Network, some $715 billion have a specific impact mandate as at the end of last year. The IFC estimates this number to be closer to 2.1 trillion. What these numbers tell us is that asset owners worldwide are adopting sustainable investing in record numbers. For instance, Morgan Stanley shows that 4 in 5 institutions are actively integrating sustainable factors into their investment processes, and 15% are considering doing so. A further 57% of us asset owners are expected to allocate to managers with a formal ESG approach in the future. As things stand now, $747 billion has been invested in green and social bonds. Now finally, the chart at the bottom right shows which SDGs are targeted by investors as polled by the IFC. And you'll see from that access to affordable and reliable energy is the top of the investment theme, which is not surprising given that it affects all facets of our lives. It is followed by food security, employment creation, and good health. It may interest you to see where global investors are directing their impact capital. Most of the respondents polled by the IFC are based in North America and Western Europe. 4 out of 5 of them invest in Sub-Saharan Africa, Latin America, and the Caribbean. And not much investment is actually internally directed, as you can see from the bottom 2 bars. The GIN's data, on the other hand, paints a different picture. They report that more than half of all investments are in North America, followed by the Sub-Saharan Africa. In the previous slide, I showed you the main SDGs impact investors are targeting. The graphic on this page shows the thematic preferences of these investors. Financial inclusion is the most popular theme, followed by green technologies. On top of that, financial inclusion is a key theme in emerging markets. So there's clearly an obvious relationship between themes and the target market of these investors. Sustainability is a progressive process with financial and non-financial objectives in different stages. This spectrum of capital illustrates that investors have been advancing from the left side, where portfolios are constructed solely with the intention of generating financial returns, and moving towards the right side into illiquid assets, where portfolios are constructed with impact objectives only. At the extreme end, investors aren't really expecting financial returns, or you could say they're expecting pretty low returns. The strategies in the middle are about how much weight is given to social and environmental factors, from negative screening to true impact investing, where positive social and financial returns are the main drivers. Some of the main long-term trends emerging from international experience include that there's a strong interest in sustainable investing and impact. Most of the client interest, as I've shown in the earlier slides, is in SDG solutions and in thematic strategies. And second, measurement tools are improving over time. As the quality of data improves, there's a harmonization of metrics, indicators, and the data used. Third, the challenge of climate change remains a priority. Fourth, many investors prefer ESG integration as an expression of their sustainability intentions. And finally, fund managers are investing in reporting and education. And the reasons for this should be obvious. Fund managers want to understand where the pockets of value are that can be used to capture alpha, and stakeholders are demanding greater and greater transparency. Like other areas of asset management, the initial wave of interest in sustainability came from institutional investors, as they have been vocal in demanding that their capital be used to generate positive social and environmental outcomes. And this is because the evidence of bottom line effect of ESG and opportunities to generate alpha is overwhelming. Other notable factors that have been influencing asset managers to adopt ESG include policy responses to things like low or zero carbon movement and the need for alignment with their own internal values. So, why has impact measurement taken center stage? Well, the main reasons impact needs to be measured are: 1, to better understand the impact. That is, there's recognition that ESG factors that affect both risk and return. ESG is a risk mitigation strategy, so we want to understand what the risks are so that we can actually put in place mitigating strategies. We also want to understand where the pockets of value are that we can capture alpha. 2, to proactively report impact to stakeholders because they are demanding greater transparency about how their funds are invested. And 3, because it's good practice and there's abundant guidance on how ESG factors should be included in risk management. But it's not just the environment-related impacts on the company that can be material, but also the impacts of a company on the environment, which actually clears up a lot of the noise, because it allows a company then to focus on material impacts, both internal and external. Understanding this link between inward and outward impact enhances the value of assessments for reporting. It also links ESG reporting and metrics with real-world outcomes, and these need to be framed around the outcomes and the impact they create as a result. What I want to show on this slide are the 5 pillars that characterize impact investing and differentiate it from other approaches of responsible investing. They also influence the success or not of the strategy. And these are, first and most importantly, is intentionality. And this is the upfront objective for positive social and environmental outcomes. 2 is materiality. And this is that there should be positive outcomes that are of material significance. 3 is additionality, and this is the extent to which the necessary products and services are being made available. And 4th is negative consideration. So these are the products that shouldn't undermine the positive impact. And followed lastly then by measurability. And this is the methodology to measure and report on impact performance. This graphic is from the Impact Measurement Working Group, and it recognizes an impact value chain that starts with input level data and progresses to activity, output, outcome, and impact level data. The practice can be summarized in 4 main phases, which are plan, do, assess, and review. And the guidelines, the goal setting, selecting matrix, collecting and storing data, and so on, provide an effective measurement framework. However, when adopting the framework, investors have to consider resource availability, requirements from external stakeholders, and the objective of impact measurement. Environmental impacts tends to be easier to measure than social impacts, clearly, because there's obviously more quantifiable data, such as the amount of CO2 emissions that's avoided, the number of gigawatts of renewable energy produced. Social impacts, on the other hand, may include the number of affordable homes provided. However, it's difficult to get consistency of measurement across the different investments because of the vast array of impacts, a lack of commonality, and difficulty in quantifying and comparing impact. The first problem is obviously lack of standardization. There is no standard template or benchmark for measuring impact. Practitioners are now obviously coming up with that, and the different managers of impact mandates are coming up with their own. But unlike financial returns, where there are things like the IRR of return, volatility of risk, there is no standard measure in impact. And unfortunately, this is also the reason some people are unconvinced that it can be measured and that there's no standard formula for it. Secondly is the cost of gathering and analyzing data. The lack of data has always been a problem because there's limited capacity, and the additional costs end up putting people off from actually measuring it. And then there's a time that it takes to do this, the time horizon of the impacts. The long-term theme of impact means that confidence and credibility take a long time to earn. It takes a long time to actually build the impact story. The imbalance challenge here is a reflection of the scale of the challenge, say environmental challenge, relative to the investment opportunity set that's available and our levers of influence. The other challenges that you see here are typical of a nascent sector, such as the lack of standardization, as I mentioned, particularly in the definitions and in actually the measurements and the tools that are used for that. The coming slide, the next 3 slides, I'm going to be discussing more from our perspective as Momentum Alternatives, how we deal with these things. So from our perspective, we manage impacts in 3 themes. Alternative energy, which invests in renewable energy and related technology like energy storage. Social infrastructure, which invests in student housing and affordable homes. And thirdly, diversified infrastructure, which holds a range of infrastructure, such as telecoms and toll roads. These 3 funds map to the 6 SDGs that the business has prioritized. One way to measure progress, which we are using, is to focus on the 5 Ps that shape SDGs. These are people, planet, prosperity, peace, and partnerships. The 5 Ps highlight how the SDGs are an intertwined framework where progress on one supports and balances progress on another. Again, we view the first 3, so that's people, planet, and prosperity, as central to our impact narrative. They, in turn, align with our objectives to promote a transition to a low-carbon and sustainable future, to support development of communities, and to advocate for ethical and transparent corporate culture. But what is our impact measurement philosophy? Well, we've tried to align our process with the impact management project's 5 dimensions of impact. So what is your goal? What is affected? What is a contribution? What is the impact risk? And how is change happening? The impact objectives adopted should determine what is measured and how success is achieved. We are constructing our impact measurement and management framework around the combination of the theory of change and the logic model. These 2 frameworks are the most popular in this industry, and obviously they're the ones that make most sense for people who are investing in the kind of technologies that we are. Secondly, and I guess most importantly, is to assess the difference being made. That is the desired impact being achieved in the way anticipated and the outcomes expected. And there are tools in the markets to measure this and to quantify this if one cannot do it yourselves. Lastly, like many investors, we have mapped impact objectives to the SDGs, which, as I've indicated, does make sense. So you would want to have impact matrices that can easily be matched to specific SDGs. So in conclusion, we have discussed today what the global trends are within the impact space. I've given you an idea of the drivers of these trends, and I've also given you a sense of how we as Momentum Alternatives are dealing with impact and implementing our impact mandates. I'm very happy to discuss this with you in case you do actually have an impact objective that you're looking to achieve. We'd be very happy to look at alternatives of what we can use to achieve this for you.
Well, in our next comfort break, we'll show you a short video about how our concentrated solar power project is operating in Uppington.
Our mission statement is simple. It's about unlocking the green economy. And basically this is part and parcel of unlocking the green economy, basically looking at how renewable energy can play a core part into this whole green transition. Other people ask me about where does the name Imvelo comes from? Well, it comes from the Zulu word as Imvelo. I remember growing up, my parents always saying, you have to be in tune with nature. You have to be, in tune with the environment. So that's where we take our name from, Imvelo. It's about actually connecting with nature and the environment to do this kind of things.
Welcome to Karushoek, Ilanga 1 concentrated solar power project. Today we have traveled to an incredible location in the beautiful Northern Cape. to see how Momentum Investments is building a greener, more efficient future for our country.
The Northern Cape, where we stand today, has got one of the best solar irradiation in the world. And this specific site is in an area called Karos. It's flat land, vast pieces of land. They're ideally suitable for this type of technology. This is what we call a thermal energy storage solution. It has inside it molten salts. So on the right-hand side, we store at 200 degrees Celsius, and on the other side is the hot tank at 400 degrees Celsius. So what do we do with it? It works like a battery because during the day, you're getting your solar field, producing the electricity from there. And part of the steam, we put it in here. This is your big battery. So, you know, there's this analogy that solar cannot run 24/7. The partners we work with, we've configured how we can do it. We can produce base load electricity. That is power around the clock. So this is our water treatment facility. The water comes from the Orange River. We pump it 11 kilometers, and then it comes here, it gets treated here, and then we got our dim water that actually then goes into the facility. It was about how you develop a project in such a way that you can improve the social fabric of the people living in all the areas that are actually surrounding Ilanga CSP1. At the heart of construction, there were 2,000 construction jobs here. The people living in the nearby communities built this with the international guys who brought in the technology. So part of the benefits of bringing something like this, it's creating the jobs of the future. And in addition to that, creating clean electricity, greener electricity, that is good for everybody's health because there's no pollutants. And at the same time, it's helping South Africa meet its climate change obligations around reducing its carbon dioxide emissions. I think, for me, this can be the mecca of renewables, creating new jobs, new industrialization for the better of everyone.
I am often in awe and humbled by the incredible country that we live in and by the wealth of beauty that we see around us, from the dramatic landscapes to the smiling faces on the people that live here. Taking this trip has once again impressed upon me the fact that we as corporate citizens have a duty to build a better world, to embrace projects like this and to help grow a sustainable tomorrow. Standing here in this fantastic space surrounded by such an amazing project, I'm once again reminded that we at Momentum Investments truly do live our mantra of doing well by doing good. Because with us, investing is truly personal.
Kamini Naidu is the Senior Fund Manager focusing on hedge funds at Momentum Investments. Now, hedge funds present interesting opportunities to generate uncorrelated returns in a highly uncertain and volatile environment, which is very much the landscape that we're currently living in. Kamini discusses how hedge funds have evolved and are adapting for the future. Let's take a look.
Thank you, Gugu. Walt Disney said, "I suppose my formula might be dream, diversify, and never miss an angle." I thought this quote pertinent to investments too, given the recent uncertainty and continuously changing investment landscape. Investors are trying to ensure they don't miss an angle, and portfolios are appropriately diversified. Today, I'm going to take you through how the landscape is changing and some of the ways that we can take advantage of those opportunities. The investment landscape can largely be split between public and private markets. Traditional investment strategies are used to extract returns from public markets, while alternative investment strategies are often used to extract returns from private markets. The challenge at the moment is that listed markets globally are shrinking, as we see a greater number of delistings and mergers that combine multiple stocks, reducing global stock exchanges. At the same time, companies are taking longer to list, choosing instead to access private capital and list much later. And after much more of the wealth has already been generated for private market investors. So in an environment where the number of listed counters is declining, and we have this increased uncertainty, investors not looking at alternative investment strategies are limiting their return fishing pool. A shrinking market does limit the return potential for traditional investment strategies, but also creates an opportunity for alternative investments, such as hedge funds and for the private market strategies. Today, I will be exploring the opportunity for hedge funds, and Rian Smit will be looking at the private equity strategy in this environment. First, let's take a step back and consider the different strategies and roles of the hedge funds. So hedge funds are investment strategies that have at their disposal a wider toolbox to generate returns. Fund managers use this toolbox quite differently to create a range of different profiles. And because these profiles can be so different, the role that the hedge fund is intended to play in a portfolio also varies. So hedge funds can be seen broadly as either risk reducers, so volatility dampeners, or return enhancers. The main aim of an investment in a hedge fund is to diversify risk exposures away from traditional market betas. And in the South African market, much of this is focused on diversifying the equity and fixed income exposures. Today, we are not going to be delving into the fixed income hedge fund strategy, but I will make a few comments on this strategy for completeness. So in the context of fixed income, most fund managers do not manage the funds with any duration consideration. So the strategy is largely dependent on the ability to correctly read the monetary policy, fiscal policy, and flow dynamics across the various fixed income curves. So this allows an investor access to risk and return sources across the fixed income assets, so diversifying away from some of the more traditional fixed income exposures. Equity beta can be diversified across a number of equity hedge fund strategies. At the bottom of this range is the market neutral strategy, which tends to run with a mandate of no net exposure, so no directional market beta exposure, with the intent to hedge out all systemic risk and generate returns purely through stock picking. These tend to fill the role of risk reducers, so the volatility dampeners in a portfolio, and target cash plus type return profiles. Many of the lower beta type strategies are aiming to extract returns predominantly through arbitrage opportunities created from price discrepancies in the market. Hedge funds look to exploit these pricing discrepancies by using a combination of going long on one of the assets and taking short positions in the other. On the upper end of the spectrum is the portable alpha strategy, which are targeting a return in excess of an equity market beta through the use of the wider hedge fund mandate. This would typically fulfill the role of a return enhancer in a broader portfolio. And there are various mandates and profiles in between, as you can see. A lot of these profiles are generated through varying the net exposure. So the net exposure is the effective beta exposure, and these funds are then able to create these diverse profiles. The strategy most suited to taking advantage to the price discrepancies being created by some of the corporate events I spoke of is the event-driven strategy. What are event-driven strategies? These are strategies that look to exploit mispricings in stocks that come about as a result of corporate events. The first such strategy is merger arbitrage. So merger arbitrage is a strategy where the hedge fund invests in companies pending mergers, takeovers, or other corporate reorganizations. Each investment tends to trade on idiosyncratic deal dynamics and normally exhibits low correlation with other investments in a portfolio, making it a great diversifier. Merger arb can be likened to flying a plane. So air travel is one of the safest modes of transport. The pilot does tremendous research to ensure the trip goes as smoothly as possible, checking the weather at the destination, the weather en route, really going through a detailed checklist to prevent any problems that may occur. So this is similar to a merger arb, as the manager looks at any problems that could occur and crosses them off the checklist before takeoff, so before position entry, and continues to cross off points in the checklist through the journey. A merger arbitrage strategy invests in companies being acquired, profiting as prices converge to the bid level. An efficient market response would see the share price almost immediately reprice. However, there are a number of factors, so the checkpoints, that need to occur for the deal to close, so adding to the complexity of evaluating the securities subject to corporate activity. An event-driven investment manager, the pilot, seeks to analyze the deal terms and hurdles to identify mispricings and identify this alpha capture opportunity. This slide illustrates what happens in the case of a potential acquisition. When a company signals its intent to buy another company, the stock price of the company to be acquired typically rises. However, it usually remains somewhere below the acquisition price, a discount that reflects the market's uncertainty about whether the acquisition will truly take place. That's when the event-driven investor enters the picture. An event-driven investor will analyze the potential acquisition, looking at the reason for the acquisition, the terms of the acquisition, and any regulatory issues, and then determine the likelihood of the acquisition actually occurring. If it seems likely that the deal will close, the event-driven investor will go long the stock of the company to be acquired and sell short the acquiring company. As the deal moves closer to closure, the spread typically narrows as the risk dissipates. Let's look at an actual example of this in our local market. So Liberty Holdings has, for a number of years, been a listed subsidiary of Standard Bank. On the 15th of July, Standard Bank and Liberty Group made a joint announcement that Standard Bank has made an offer to acquire all the shares of Liberty not held by Standard for a mixture of cash and shares. This chart shows the response in the Liberty share price following that announcement. The offer was that each Liberty shareholder would receive a combination of Standard Bank shares and cash in return for their Liberty share. The transaction is only expected to settle in February next year, following a number of procedural and regulatory requirements that need to be met before the transaction can be settled. Again, these are the checkpoints. So, as the offer is a combination of cash and shares, the ultimate value that a Liberty shareholder will receive is dependent on the Standard Bank share price at the time that they receive the shares, which will continue to fluctuate with market conditions. A long-only shareholder is unable to easily hedge their future exposure to Standard Bank. A hedge fund, though, can short the shares and provide liquidity to Liberty shareholders looking to sell their Liberty shares if they believe that the Standard Bank share is undervalued at a point in time. The fund manager estimates the settlement date of the transaction and the fair value of the Liberty share based on that Standard Bank share price, and will monitor the discount through time relative to the transaction terms. This allows him to trade around that discount and lock in a near riskless fixed return. Given the time frame to settlement reduces over time as the settlement date approaches, you can expect that discount to narrow over time, helping them yield that profit. The other type of event-driven bucket is the special situation strategy. So this strategy invests around non-standard events, including divestments, spin-offs, special dividends, and unbundlings. Opportunities can present when investment holding companies decide to unbundle some of the assets or undergo corporate restructuring. An investment holding company is usually set up for a specific reason and can hold both listed subsidiaries or unlisted assets. The fund manager adds up the value of those stakes and compares them to the value of the company at the top of the pyramid. If the value of the company at the top of the pyramid is less than the sum of its investments, and it almost always is, then it's trading at a discount to net asset value. So we say discount to NAV. So by distributing the shares to its shareholder, that value is unlocked. This chart illustrates an example of this in our local market, with the unbundling of First Rand from Rand Merchant Holdings, RMH. So as background, RMH started purely as a holding company for First Rand. At some point, the decision was taken to start including property, and the discount started to widen. This fluctuated but seemed to get stuck at around 13 to 15%. Hedge funds went long RMH and short First Rand anticipation of the unbundling and the narrowing of the discount. Once the announcement was made late Feb, we see that the discount did actually narrow and they were able to profit from their trade, but still the discount stayed at 5% of NAV. The valuation of the property assets still looked attractive. The group announced that they would place 6 billion rand of First Rand shares at a discount to cover debt and raise capital for the property assets. The managers continued to short First Rand as this will be covered in the placement, and this is effectively riskless. Post the unbundling, the managers left exposed to the undervalued property assets. Days prior to the ex-date, the implied rump, which is your assets excluding First Rand, was still trading at a roughly 80% discount to the pro forma RMH. The fund anticipated significant RMH selling as it became insignificant in many portfolios. This creates an opportunity to use flow and the opaque nature of valuation to trade around that discount. Once the transaction is concluded, the fund manager will sell a portion of RMH, but continue to retain exposure to those undervalued assets that are expected to unlock over time. I have hopefully provided some of the color on how hedge funds can extract returns from some of the opportunities presenting themselves as a result of the corporate activity on the exchange. While the number of listed equities is shrinking, the opportunity in the unlisted market remains. I will hand over to Rian Smit to take you through this.
Thank you, Carmini. Whereas hedge funds can give investors a wider set of tools to use in executing an investment strategy in the public equity markets, private markets can potentially give investors a wider universe of companies to invest into. A lot has been written about how 20 years ago, the JSE was dominated by the resources counters and the large number of mining houses. It was all Anglos and Billiton. That's all you heard. Now, many decry the Naspers effect and that some indices are dominated by Naspers and Prosus. That only tells half the story though. Many investors, analysts and even regulators in South Africa lament the sure but steady decline in the number of listed companies on the JSE and the newer stock exchanges in South Africa. To put this into perspective, the JSE peaked at well over 750 listed companies in the late 1980s. Over the 20 years from the year 2000 to 2020, this number has steadily declined from around 600 to roughly 330 at present, effectively a decline of 45%. Over the same period of time, the total market capitalization of these companies actually increased from 1.6 trillion rand to 18 trillion rand. Roughly an 11-fold increase in rand terms. Or if we express that in US dollar terms, it increased from $260 billion in the year 2000 to roughly 1.2 trillion US dollars at the end of 2020. This decline in the number of listed companies is not unique to South Africa though. Whilst the market capitalization of the US equity markets have increased dramatically over the past few decades, the number of counters has also steadily decreased. Over the time frame as mentioned earlier, from the year 2000 to 2020, the total market capitalization of the US equity markets increased from around 15 trillion US dollars to over a staggering 40 trillion US dollars. Over that same time horizon though, the number of stocks decreased from around 7,000 to close to 4,000, representing a decline of 46%. Interestingly, roughly the same percentage decline in the number of counters as in South Africa. This phenomenon also holds true for the European area, though not to the same extent. But we should be aware that China is the notable exception, where both the number of companies as well as the aggregate market capitalization has increased exponentially. This phenomenon is due to a number of reasons, including delistings of smaller companies, either due to the costly compliance requirements or these companies failing to meet the listing requirements of those exchanges. Mergers, acquisitions and takeover activity, as Carmini had alluded to, fewer initial public offerings to offset the delistings and M&A, the growth in private markets, and lastly, the very reason for seeking an IPO in the first place, which is generally to raise capital for growth or expansion. And many companies are doing this in the private markets rather than to seek an IPO. Global private equity activity has picked up in the second half of 2020 with a value of $381 billion, exceeding that of any semi-annual period as far back as 2007, when the previous high of deployment was $525 billion, and that was in the first half of 2007. Judging by the hive of activity in the first half of 2021, when the global transaction value is estimated to be close to $584 billion. This sets the full 2021 year up for the record in private equity activity, exceeding the lofty heights last seen in 2006 and 2007, just prior to the global financial crisis. This surge in activity is driven in part by global record low interest rates and, coupled with it, the availability of debt funding, pent-up demand for investment activity following the global lockdowns in response to the COVID-19 pandemic, encouraging signs that the pandemic may be moderating due to vaccination drives and some natural immunity in many regions, and a significant amount of undrawn commitments, or the proverbial dry powder, that these private equity firms have that they can deploy. Private equity's share of M&A activity has increased steadily over the past few decades, from roughly 23% in 2007 to close to 29% so far in 2021. This again just shows the steady increase in importance of private market investments. Private equity managers in South Africa have also been able to raise and deploy more and larger funds, though some of this capital is also earmarked for deployment into Africa. The assets under management of private equity firms in South Africa have increased from roughly 35 billion in 2001 to over 200 billion rand at the end of 2020. This 200 billion rand includes roughly 33 billion in undrawn commitments or dry powder that can be deployed in new and follow-on investments. Similar to global activity, South African private equity activity has also contracted significantly in the aftermath of the global financial crisis, both in terms of value and in volume. Post the GFC, there were clearly more follow-on investments, but new investments did not get left behind completely. After 2016, both volume and value of private equity activity increased dramatically, peaking at over 35 billion, being deployed over more than 500 investments, only to contract sharply again in 2019, and even further in 2020, as could be expected as the COVID-19 pandemic hit. On the flip side of fundraising and investment activity, exits by global private equity firms have also picked up pace in the second half of 2020 to record levels, topping those previous records set in 2014 and 2015. Still, the most dominant exit route for private equity players are trade sales, comprising roughly 60% of all exits in terms of deal value, followed by secondary sales to other private equity players or financial institutions at a roughly 25%. IPOs, though, have been fairly consistent as an exit route, making up around 10% of the value of all exits. And special purpose acquisition companies, so-called SPACs, for short, which now comprises 6%, up from around 2% only 5 years ago. Through all this, the trend is clear. More firepower, more companies and bigger deals in private markets versus a smaller number of publicly listed companies. Turning our eyes back to South African private equity exits, it is interesting to note similar trends as in the United States and Europe, being exits are dominated by trade sales. Secondary sales to other private equity investors or institutions are second-ranked, and fewer initial public offerings, even when compared to historical volumes in South Africa. It also becomes apparent that companies stay private for longer and that private market holding periods are also typically increasing. Similar trends are clear across the globe. So how have these South African companies that were previously held by private equity funds fared once listed? A few examples. Transaction Capital, that was listed in 2012, initially lagged the JSE All Share Index. But since 2016, it has grown exponentially and well and significantly outperformed the ALSI. Next to list was Ascendus Health in 2013. And whilst it initially outperformed the ALSI, Ascendus' share price peaked in 2016, and the company's trouble of being overgeared are well known and publicly available. Alexander Forbes listed in 2014 and has sold numerous of its insurance businesses to other financial institutions over the years, as it realigned its strategic objectives to focus on the advice-led business. It has also returned significant amounts of capital by way of ordinary and special dividends, which are not captured in the share price, unfortunately. Rhodes Food Group, also listed in 2014, and comfortably outpaced the All Share. It was, however, hard hit by the COVID lockdowns, which impacted volumes in the main categories of food products. Lipstar, which was initially a buy and build strategy by a local private equity manager, Metier, and was sold as a secondary to Abrage in 2014, also listed in 2018. This is a handful of examples, or a bit of a mixed bag in terms of share price performance, but it illustrates the point that an IPO is not the be-all and end-all as an exit route, and why some companies prefer to remain privately held or simply stay private for longer. SA private equity funds are also prolific actors in taking some businesses off the JSE, either by way of a take-private, otherwise known as a delisting, or by carving out an unloved or non-core division, segment or unit from the company that wishes to remain listed. This in turn allows the listed parent to focus on its core activities. Some notable take-privates and carve-outs from the SA listed market over the last 10 years are as follows. Respiratory Care Africa, carved out from Ascendus Health in 2021 for 460 million rand. Peregrine Holdings, a complete take-private by Capital Works for around 4.5 billion rand in 2021. Master Plastics, a take-private by Metier for 270 million rand in 2019. Synerlytic, from the previously known Torre Industries, a take-private by Ethos for 442 million rand in 2019. Petman, a take-private by Capital Works in 2017 for 1.1 billion rand. Sovereign Foods, also by Capital Works in 2017 for just under R1 billion. Neopak and Twinsaver were both carve-outs from Nampak by Ethos for roughly 860 and 760 million rand in 2015. Vox Telecom, which was a take-private by Metier, RMB and Investec for roughly 500 million rand in 2011. As you can see, take-privates and carve-outs easily outpace initial public offerings in the South African landscape, especially from the private equity investor's point of view. So in conclusion, if you wish to hedge your bets, don't just bet on the public markets. Spread some of your bets to the private markets too. There is a world of opportunities. You just need to find them.
Well, it's time now for yet another comfort break where you can stretch your legs, network and interact with your peers on this platform, and of course, grab a refreshment. But while you do that, we'll now show you Karen Zoid's beautiful song in this comfort break called Guiding Light, which was written for our Women's Month event earlier this year in August.
Hold your head up straight, put your shoulders back. Don't forget to smile, should you be wearing that? Should you be wearing that? And work twice as hard for half the sake. Don't be too direct, she's such a bitch, they'll say. Oh, the things they'll say. she is. Every time you lose, someone should tell her, please. Fate is what you choose. Believe the guiding light is truly yours. Never admit that you need more time. Learn to hide your wit, learn to act surprised, and be one of the guys. Act like a CEO, work like you don't have kids, and when you are at home, pretend it's your career. Hide your fears. Every time you win, who does she think she is? Every time you lose, someone should tell her, please. Fate is what you choose. Believe that guiding light is truly yours. Every time you cry, they say she fell apart. Every time you fight, they say she has no heart. Take a look inside and see that guiding light is truly yours. Truly yours, it's yours. Ooh, that guiding light. Hold your head up straight, put your shoulders back. Don't forget to smile, should you be wearing that. And work twice as hard for half the pay. Don't be too direct, she's such a bitch, they'll say. The things they'll say. Every time you win, who does she think she is? Every time you lose, someone should tell her, please. Fate is what you choose. Believe that guiding light is truly yours. Every time you fall, there's a lesson learned. Those who stand up tall also have been burned. You can have it all. Believe the guiding light is truly yours.
Unlisted and diversified credit opportunities present high-yielding and compelling sources of return that are increasingly important and should be considered as part of a well-constructed and diversified fund. Chris, a senior fund manager of Momentum Special Opportunities Fund at Momentum Investments, expands on this exciting and innovative area of investments and how this is shaping up to be a key investment opportunity set for the future.
Thanks, Gugu. Investing in distressed opportunities is an accepted and common investment strategy overseas. It's a nascent investment asset class in South Africa, and one which we are excited about for two reasons. There are social benefits to saving companies in distress. Think saving jobs, livelihoods, contribution of tax to the fiscus, and equally important, there are significant upside returns for our investors. The reason the Special Opportunities Fund is considering investing in distressed opportunities is a function of the mandate. The fund has a target return of CPI plus 6, gross of management fees, over a 6-year investment horizon, meaning that it is a long-term investment. The intended payoff profile is equity-like upside with debt-like downside. The investable universe includes unlisted and illiquid investment strategies and securities, including both debt and equity. It's designed to provide an element of downside protection during periods of market stress. Now let me introduce you to a project called Project Feed, which is a 40 million rand investment of PCF, being post-commencement finance, an investment in the company post the commencement of the business rescue process. The reason this is important is because of the role this company plays in the global supply of therapeutic foods. It's a top 5 producer of therapeutic foods. Customers include aid agencies, school feeding programs, hospitals, people living with AIDS. The largest demand tends to be in regions experiencing war or drought. So think Afghanistan, Sudan, Mozambique, Yemen. This is a significant company with turnover of approximately 500 million rand a year, GP margins of 35%, and net income margins of 7 to 10%. Now, in order to understand the process, I'll take you through business rescue on a high-level basis. Business rescue is defined in section 128.1 as proceedings to facilitate the rehabilitation of a company that is financially distressed, providing for the temporary supervision of the company, the management of the business and its affairs and property, a temporary moratorium on the rights of claimants against the company. That means creditors can't enforce their rights and require enforced payment. And the development and implementation of a business rescue plan, the purpose of which is to either return a company to trading on a solvent basis or to provide a better outcome to affected parties than if the company was immediately liquidated. The Companies Act defines financially distressed in section 128F as a company that has a reasonably unlikely that the company will be able to pay its debts within the next 6 months, or it is reasonably likely that the company will become insolvent within the next 6 months, meaning that its liabilities will exceed its assets. In the event that a company is financially distressed, it is important and imperative that the directors of the company recognize such and place the company into business rescue. Otherwise, they can be accused of trading recklessly and will be held personally liable for losses of the creditors. Companies can be placed into business rescue through either a resolution passed by the directors or through a court action by stakeholders, creditors, employees. A business rescue practitioner is appointed once the company is placed into business rescue. If the directors were able to apply for business rescue, then they have the right to appoint their preferred business rescue practitioner, which has benefits in that they have a friendly voice running the company. If it's a court-appointed order, then the court will appoint the BRP. The size and the complexity of the company will determine the required seniority of the appointed business rescue practitioner. The business rescue practitioner has full authority and takes complete control of the management of the company in substitution of its board and pre-existing management. The BRP may delegate any power or function of the practitioner to a person who was part of the board, and they may remove from office any person who forms part of the pre-existing management company. The BRP may also appoint a proxy to perform certain functions. So in essence, the business rescue practitioner is in control of the company. Now, the business rescue process is a legal process with a defined timeline. In terms of timeline, we talk in business days and not calendar days. Day 0 being the date in which the company was placed into business rescue. Within 5 business days, the business rescue practitioner needs to notify affected parties that the company is in business rescue. This is through email, posting of a notice on the company's website and offices. Within 10 days of filing of business rescue, the business rescue practitioner must hold separate meetings with creditors and employees, explaining why the company is in financial distress, whether the BRP believes there is a probability to rescue the company, and to explain each stakeholder's respective rights during the process. Within 25 days, the BRP is required to develop and publish a business rescue plan that either provides for a rehabilitation of the company or a better outcome than immediate liquidation. This is typically a structured wind down, which is a managed sale of assets as opposed to a fire sale. It's important to note that given most BRPs are not familiar with the company in which they're appointed, it's extremely unlikely for them to put together a
suitable business rescue plan, and therefore it's common for BRPs to request an extension to the 25-day period. In order for that to be effected, 50% of the creditors need to approve such vote. Within day 35, so 10 days after the posting of the business rescue plan, the affected parties vote on the plan. Now, the outcome of the plan needs to provide a better outcome than if the company was to be liquidated. That means that an independent liquidation calculation is required. This independent liquidation calculation needs to be prepared by a party that's independent from the company and the BRP, the purpose of which is to determine the net realizable value of the company's assets once sold. This provides a minimum expected recovery for the creditor per the waterfall, being either secured, preferent, or concurrent. As I said, the BR plan needs to provide an outcome which is better than liquidation. The key attributes of a business rescue plan include the reasons for the initial financial distress, who the key stakeholders are and their respective claims against the company. The plan needs to describe a turnaround plan, if that's the intention of the business rescue practitioner, and how much capital is required in order to execute the plan. It's important to know that companies need working capital, and those companies in business rescue are unlikely to get terms from their creditors. What is the expected recovery for each class of creditor? And by this, what is the proposed dividend that is going to be paid to the creditors? The business rescue plan will also include key determinants of substantial implementation. These are the deliverables that need to be effected by the business rescue practitioner before the company can exit business rescue. Once the BRP has effected the various deliverables and is confident the company can be returned to a solvent state, the BRP will file substantial implementation and the company will then exit business rescue. In terms of voting on the plan, this determines whether a plan will be passed or will be rejected. Affected persons are asked to vote to either approve, abstain, or reject the plan. In order for a plan to be passed, 75% of the independent creditors by value of their claim and who are present and voting at the time need to approve the plan. Now, one rand of claim equals 1 rand of vote. And whether you're a secured creditor or a concurrent creditor, your vote is equal. Shareholders are required to vote on the plan only if their rights are affected. And by that, whether their holding in the company is diluted or not. If they are diluted, then they get to vote. And 50% of the votes required in order to get their vote to pass the plan. If the plan is approved, it is binding on all affected parties, including the compromise, which is the write-off of creditors. The debts being expunged are no longer owed or payable by the company to the creditors. An example of this is if the BR plan offers concurrent creditors 10 cents on the rand recovery. This means that 90% of their claim pre-business rescue is written off. It's important to note that only those claims that arise prior to business rescue are compromised, and claims that are incurred during the business rescue process are referred to as PCF, post-commencement creditors, and are required to be settled in full should the plan be approved, including a turnaround of the company and recommencement of operations. If the plan is not approved, the BRP can seek permission to go back to the drawing board and redraft the plan, or the BRP needs to file for immediate liquidation of the company. Once the key attributes of the plan have been fulfilled, an example of this might be to shut down specific operations, to exit various leases, to rationalize headcount. The BRP will then file substantial implementation with the SIPC. The company exits business rescue, and the business rescue practitioner essentially hands the company back to the directors and the shareholders to run. That was an overview, a very high-level overview of the business rescue process. Now let me talk to Project Feed. And the reason the company was in financial distress and hence business rescue was that it was growing too fast. It started to buy significant amounts of raw material in anticipation of a growing order book. The excess raw material required additional warehousing, which came at extra costs, and a duplication of roles, increasing the monthly overhead. There were inadequate inventory management systems and poor financial controls. COVID affected the production speeds. People were sick. The company was unable to get spare parts because of the issues with shipping lines. That meant that it couldn't convert the raw material into finished goods and required additional warehousing. The final nail in the coffin was the majority of the earnings are dollar-based, and the company did not have a dollar hedging strategy. This helped the company while the rand was depreciating, but when the rand appreciated significantly, it led to significant FX losses for the company. The key attributes of the turnaround plan included a rationalization of the product range, focusing on higher margin products. Fewer products means less production capacity required. A reduction in footprint, specifically warehousing, was needed, reducing operating costs. In addition, the production, warehousing, and dispatch operations could be housed under one roof, increasing efficiencies and reducing duplication in roles. This led to a reduction in headcount and monthly overheads, making the company more competitive and more sustainable, and key management was required to be replaced. The creditor compromise was significant. Creditors were offered a total pool of 10 million rand. Prior to this, trade creditors were approximately 75 million rand. So you can see the compromise being about 65 million rand. That is significant. It does mean that the company's balance sheet improved post the compromise. As I've said earlier, in order to start operations, companies need working capital and hence the injection of PCF being post-commencement finance. Going into the business rescue, the company had significant amounts of raw material on hand, and the BRP estimated that a total of 40 million rand of funding would be enough to restart operations, to settle outstanding PCF creditors, including employees, landlords, arrears, etc., and to buy sufficient raw materials to manufacture 2 awards with a sales value of 90 million rand, which would allow the company to generate sufficient free cash flow to continue trading on a solvent basis and essentially work its way out of this trouble. The current status of the transaction is that the PCF agreement has been concluded. The BRP the plan has been approved by affected parties and preparations are underway to restart operations. This means the company is returning to operations. At least 150 jobs were saved. Thousands of starving and malnourished people around the world will receive the nutritional supplements that they need. And on a financial basis, the investors have required the company that in 3 years' time will be worth between 120 and 160 million rand for a 40 million rand debt investment. This means they're going to make between 3 and 4 times their money back over that period. These are equity-like returns with social benefits. As you can see, we're extremely passionate about this investment strategy due to the social benefits it affords and the upside financial returns for our institutional investors. We look forward to hosting any questions you may have about the fund or the strategy in the future. Thank you very much.
Responsible investing practices have always resonated with Momentum Investments' outcomes-based investing philosophy and the alignment of the company's clients' long-term goals to positively influence the world they will retire to. You can watch our video about this in our comfort break.
When it comes to responsible investing practices, we follow an integrated approach. Environmental, social and governance, or ESG risks, are relevant to each asset class and affects the performance of the overall investment objective. Therefore, we continually upskill our investment staff to understand how to identify risks and opportunities when it comes to the different asset classes and their respective complexities. This year, 17 of our investment professionals have completed the African Asset Owner Climate Awareness course, certified and accredited by the Principles for Responsible Investment Academy and BATSETA. We also make sure we integrate ESG throughout our various governance structures. The Responsible Investment Committee sets policies and provides oversight of our efforts in responsible investments. ESG integration is everyone's business and assessed in our performance appraisals, whereby responsible investment practices is a component thereof. Our dedicated responsible investment team works closely with our investment team to support the integration of ESG, promote active ownership, and facilitate research and learning. Our responsible investment specialist has a more strategic function and focuses on frameworks, policies, responsible investment initiatives, and research. Our ESG analyst has a more direct support function into the sub-investment committees and focuses on proxy voting as well as supporting the strategic engagement with investee companies. Being part of the PRI International Investor Working Group on the Just Transition provides us useful insight and opportunity to learn what information and data we need as investors to understand companies' approaches to the Just Transition. As investors, we must address climate change risks and support the Just Transition to a low-carbon economy. It is not only about phasing out polluting sectors, but also about creating jobs, new skills, new investments, and the opportunity to create a resilient economy. Social dialogue is the key to collaborate and to acknowledge in policies that a just transition is necessary. This year, we encouraged 43 South African investment managers to publish a climate change investment policy. This also includes a social dimension to ensure a just transition. Our investment team formally committed themselves to 6 of the Sustainable Development Goals to take a focused approach to achieve scale and meaningful effect. Our Sustainable Development Goal framework serves to support our capital allocation decisions and our stewardship responsibilities. Each of our investment professionals understand that it's about setting forward-looking goals to play a contributing role in achieving the Sustainable Development Goals by the target year 2030. Our framework is an illustration of our commitment to these goals through the targets we've set and includes metrics we will use to measure our progress. The goals we focus on are: Goal 3, good health and well-being, to ensure healthy lives and promote well-being for all at all ages. Goal 4, quality education, ensure inclusive and equitable quality education and promote lifelong learning opportunities for all. Goal 7, affordable and clean energy. Ensure access to affordable, reliable, sustainable and modern energy for all. To be more energy efficient and invest in clean energy sources such as solar and wind. Goal 8, decent work and economic growth. Promote sustained, inclusive and sustainable economic growth, full and productive employment and decent work for all. To promote policies that encourage entrepreneurship and job creation. Goal 9, industry, innovation and infrastructure. Build resilient infrastructure, promote inclusive and sustainable industrialization and foster innovation. To invest more in innovation and infrastructure, bridging the digital divide, promoting sustainable industries and investing in scientific research and innovation are all important ways to facilitate sustainable development. Goal 13, climate action. Take urgent action to combat climate change and its impacts. We are very proud to be part of this evolving journey. Being one of the first signatories to the PRI since 2006, supporter of the Code for Responsible Investing in South Africa, and member of the Task Force of Climate-Related Financial Disclosures, we appreciate the importance of transparency and how it drives accountability in the investment industry. We therefore publish our policies and stewardship records on our website, such as our proxy voting results and engagement register in our stewardship report. Our 2021 stewardship report will be published before the end of 2021. We want to invite you to visit our website at momentum.co.za/investments and engage with us on any questions or concerns you may have.
To wrap up today's session and bring it all together, a panel of experts well versed in the alternative investments landscape will discuss how trends in investment management, the COVID-19 pandemic, responsible investing, and the need for alternative sources of returns all come together to make alternative investments a critical component of an investor's universe. Now, this panel discussion will be moderated by Mike Atsets, the Deputy Chief Investment Officer of Momentum Investments.
Thank you, Gugu. We've come to the end of the second day of our Investment Matters conference, focusing on empowering the future. And today you would have listened to some of our thought leaders in the alternative investment space, covering infrastructure investments, private equity, and hedge funds. And you would have seen over the course of the conference, even that on the second day, the middle of the conference, we have a big focus on alternative investments, how alternative investments have moved from the periphery to the mainstream of investments. But before we delve into the panel, let me introduce the panelists, and we'll introduce the topic and then get started. So joining us online is Nicole Martins. She's the director at Martins Impact Advisory, and no stranger to the space of ESG and impact investing across the Middle East and Africa. So she's going to give us some very unique perspectives, and we're very excited to have her join us. Also with us, I have Mutlatsi Mutlanyane. He's the head of alternative investments at Momentum Investments, and he's been the custodian of our alternative investment program for much more than a decade. So he's a seasoned veteran and professional in the space. Next to Mutlatsi, we've got Kamini Naidu, one of our better propeller heads. Kamini is a senior portfolio manager in the hedge fund space. And if you ever need some numbers crunched or a fancy spreadsheet drawn up, Kamini is the place to go to. Next to Kamini, we've got Tsepo Mndlazi. He's an investment analyst focusing on private equity. And next to him, Rian Smith, a senior portfolio manager, also focusing on private equity. As I've mentioned, alternative investments have become far more mainstream. And over the last year, we've seen with the COVID pandemic, the push from the president of infrastructure investment to try and restart the economy. And in a lower yield environment, the hunt for both diversifiers and enhanced yield, that the alternative investment landscape has become far more critical and central in how we manage investment portfolios. And at Momentum Investments, it's in fact an area that we've been investing in for many, many years. So my first question to our panelists is to Mutlatsi, who's been, as I've mentioned, at Momentum for a long time, and he's really seen the evolution and the growth of the alternative space, and has also been chaperoning how the alternative landscape is changing and positioning us for the future. So Mutlatsi, taking a pause now and reflecting over the history of the alternative landscape and also projecting into the future, what have you experienced in alternative investments and how are you seeing this unfold going into the future?
Yeah, thank you, Mike. The good thing, though, about what's happened over time is that the thesis for alternatives has remained consistent. Right. So as you know, we introduce alternatives into portfolios really for a number of reasons. One of which is obviously to diversify a portfolio. So in other words, that is to decrease the correlations within an overall portfolio. It's also obviously for a risk management perspective. So you want to obviously minimize as much as you can your risk of drawdown. You want to increase your sources of alternative return. So for instance, things like illiquidity premium, specialism premium, and things like that, that give you an additional alpha in your portfolio. And those kind of themes have been consistent over time. As you can imagine, obviously, that each of those will apply in different environments and will come to the fore and be salient at specific times, depending on what the economic cycle is. So that has certainly remained consistent, and we see it as much today as we did a few years ago. The one thing that has certainly been happening now, that is, I guess, relatively new, is one that there's been a move towards increasing the universe of what is termed as alternatives. So, for instance, things like Bitcoin have now come obviously more into the fore for some investors. Things like very unique assets have now also become quite prominent as forms of investment. So the universe of instruments that we're looking at is certainly beginning to increase, and this is obviously quite a good thing. The second thing we're certainly noticing is that there's a move by asset managers to encourage investors to stay invested longer. So in private equity, as an example, we're certainly seeing a move towards permanent capital vehicles. And it's increasingly becoming a theme for some asset managers that they're looking to hold on to assets for longer. There are a number of reasons for this, obviously, which I'm sure we'll go into some of those later. But predominantly, they're encouraging investors to stay invested in specific asset classes for a much longer period, which is certainly a good thing. And then lastly, the other thing that's happening is that the alternative space is becoming very much the location where things like impact and responsible investing are happening. And this also obviously has a good justification for this, and I'm sure we'll touch on those as we go on with our panel discussion. But it's certainly a good development in the sense that the scope of what can be done within the alternative space in impact and responsible investing is huge, and it excites all of us sitting on this panel, just thinking about the possibilities and what the scope of investments are that we can utilize.
So, I mean, you raising some very pertinent issues, the issue of liquidity and long-term investing, the issue of enhancing return. The one that I really want to stop on or pause on for a second and unpack it a little bit more, we'll get to the others a little bit later in the panel discussion, is the issue around responsible investing. It's a significant theme touching every aspect of investments at the moment. So I do want to refer or bring it to our online speaker, Nicole, what we need to think about, and with your experience in responsible investment practices, and I know that you've got a key focus on the just transition, a statement of which we as Momentum Investments are also a signatory. But what's sometimes forgotten is that responsible investment practices can sometimes present you with a trade-off requirement. And the one that immediately comes to mind and is very pertinent in our space is the issue of climate change. So in addressing climate change, and we'll talk to some of our climate change funds later, there is a big pressure to try and move away from a carbon-based economy. And in the South African context, carbon is so deeply integrated into our infrastructure and the way we generate power and manufacture goods that it's not such a simple item to walk away from. So that's why the issue of a just transition, effectively not leaving anybody behind, is so pertinent and important for us, being located within the emerging markets to address it really centrally in terms of the way we think. So Nicole, can you give us some of your perspectives on responsible investing and the dynamic tension between needing to address climate change as well as taking into account the need to really focus on a just transition for all?
Thanks, Mike. And it's such a great question, and it's the question that underpins most of the policy and regulatory and also the investment decisions that we're making today in terms of this global transition from systems that are exploitative and extractive to those that are sustainable and inclusive. And what you will find is that at the moment, this issue of climate, and you raised it already, but the climate emergency is getting the bulk of the focus. And it's not because it's the only ESG issue. Rather, it's because it's the most pressing and urgent, and because it exacerbates all the other issues. So in Africa in general, and in South Africa in particular, my interactions with investors have revealed that there's a growing focus and a much greater focus and interest in the social issues. And it's mainly because those are more palpable and tangible for people. On a day-to-day basis, you can see the impact of poverty and inequality, unemployment, of poor governance on a day-to-day basis as you go about your business. And when someone starts to talk about something as all-encompassing as climate change or the climate emergency, it doesn't seem quite as real or tangible. But what's important to understand is that left unchecked, this climate change, the impacts of climate change will exacerbate all those issues. They make everything worse. What we've seen is that, the science tells us that for sub-Saharan Africa, the expectation is that we will experience, on average, double the global average in terms of temperature increase. That means that if the global increase, even if we keep that to 2 degrees, which is sort of the ultimate objective at this stage, it means that sub-Saharan African countries are looking at about a 4-degree increase in temperature. South Africa itself, just in the last few years, has already experienced in excess of a 1-degree average increase. And we've seen the ramifications of that in the agricultural sector with things like drought and Cape Town's near day zero. So when we're addressing this issue of climate, it's not possible to isolate it or look at it in silos. I think one of the things we need to acknowledge is that the idea of the E, the S, and the G being independent of one another is long gone. We know that these issues are highly interconnected, they're very complex, and that in order to address any, we need to address all. And the choice for investors and for policymakers and regulators now is it's really not a question of choosing which do we address, but rather which order do we address them in. And something like the climate emergency needs to underpin all of our decisions and our strategies going forward, and then bolted onto that and integrated into it, and in the same breath, as it were, we need to be thinking about the socioeconomic implications of that. In South Africa, specifically around the transition, because we are, as you said, such a carbon-intensive economy, the main considerations that we have are around the people and the communities and the microeconomic systems that are set up and based on these sort of carbon-intensive fossil fuel industries. And what are we going to do? How do we sustainably, responsibly, pragmatically transition those operations either into new fields or into some sort of sustainable closure or exit? And how do we do that in a way that doesn't just, rip the ability to make a living out of people's hands? So for South African investors, that's a really big concern right now, is about how do we think about these things? And there's a lot of questions around that, including, whose responsibility is it? So I think that there is a perception at the moment that it's the role of investors to solve for all social ills, which unfortunately it's not. There is a large role to be played by policymakers who have to provide the social safety net that's necessary to catch those people who don't win. I know that there's great opportunity in the transition. We talk about the sort of job creation potential, the innovation potential that comes with new technologies, with new sort of sources of energy. And that is all true, but it's not a one-for-one comparison. If you work in a coal mine today and we replace that somehow magically with a wind farm, you're not guaranteed a job. It's not guaranteed the wind farm will even be in the same province as the coal mine was. And so what do we do with those people? And so investors need to think about this in terms of what is a sustainable and a pragmatic approach to making transitions, so that we don't go too fast or too slow and we're not reckless in the way we make decisions. But it is also a very important role for policymakers there. So it brings to the fore the need for increasing collaboration and communication between the public and the private sector. There's a huge role to be played by blended finance as we do this. And then I think also there's a lot that we can do as the investor community around capacity building and education and awareness of the assets in our portfolios and the communities that those affect around what is happening. At the end of the day, this transition is real. It's inevitable. It's happening now. It's not something that we can kick the can down the road and just sort of wait a couple more years. It's happening right now. And whether it is just or fair is up to us and the decisions that we make in the short term that are going to have really long-term implications.
Thanks, Nicole. I mean, today we are really talking about alternatives, and Mklotsi has mentioned earlier about the line of sight and the real impact that you can have with alternatives. So I just want to ask you, when you look at the alternatives complex and when you look at the impact invest in, to what extent do you think that impact funds and the alternative landscape is an enabler for embedding responsible investment practices, taking into account our imperative for a just transition as well?
Well, I think that the role of infrastructure investment is pivotal. We know that in order for this transition to take place at all, there's going to be a need for significant investment in infrastructure. Everything from some of the mega projects we hear about, so the transition of Eskom, the transformation of Eskom, for example, or even something like Sasol, so Eskom and Sasol, two of the biggest emitters in the world, the biggest ones on the continent. Those are large-scale mega projects that involve significant investment in infrastructure. Equally important are going to be the millions of micro projects that need to happen that are going to be less infrastructure focused, but maybe more impact focused, or focused on what we might argue would be sort of the social infrastructure. The transition is not an all or nothing, mutually exclusive kind of thing. There's going to be room for both kinds of projects, and they require different approaches and different kinds of investment. But what's really exciting about the alternative space is that it caters for all of those. There's opportunity to get involved in all of those. And if you're focused exclusively on listed, you're probably going to miss a lot of those sort of smaller, maybe more impactful, potentially scalable projects until they get to a much bigger stage. So it's a very exciting sort of position that the alternative space is in. Infrastructure is also very exciting because of the opportunity that exists in developing or emerging markets, in the sense that in developed markets, when we look at something in the case of Europe or the UK or even the States, the infrastructure market, it's developed. And so the transition investment that's happening is really about retrofitting. So it's about trying to take systems and structures that are already in use and make them fit for purpose, which is much more complex and probably has a much lower return than does the opportunity in emerging markets and markets like South Africa, where the infrastructure itself is largely underdeveloped and the opportunity exists to start from scratch, which sounds daunting, but is actually really exciting because it gives you the opportunity to leapfrog, to learn from the lessons of other markets, to not have to go through that same developmental pathway, and to become, for example, as is the case in Kenya, renewable energy exporters in a short time. So, to answer your question, when it comes to infrastructure investment, I think the opportunity there is amazing. It's really palpable. And I think the really exciting thing there as well is that because it's coupled with the drive from public sector, there's an acknowledgement that this is a huge opportunity and that it's also necessary. We can't transition effectively without large-scale investment in infrastructure development. It also opens a lot of doors for blended finance and for innovative finance vehicles that haven't been seen before anywhere else, and that can really push us to the limits of what we think of when we think of alternative investments. On the side of impact, so in my experience, obviously, especially with the work I had done with the PRI over the last 4 years, we've been working a lot with responsible investors, which are different from impact investors in the sense that they don't seek a specific impact return alongside their financial return. But what's been really interesting is to see the trend over the last 4 years, which is that mainstream or traditional investors are increasingly concerned with the issue of impact, and not just in the sense of which ESG issues directly impact my portfolio or what is the direct impact of my investment decision on the immediate surrounding, but much more broadly investigating what is the impact of my investment decisions on broader environmental and socioeconomic stability, which in turn affects the ability of my portfolio to generate return. So it almost is, you could perceive it as an evolution in the thinking of sort of your risk management outlook, is really just thinking more broadly about the impact that I have beyond the value of that impact in and of itself, is creating an environment, an enabling environment for myself to generate future return. So I think this issue of impact is going to be increasingly important, and it's going to be increasingly a third dimension, I suppose, risk, return, and impact in responsible investment in just a sort of logical investment approach.
Thanks, Nicole. It's actually a great pleasure to have somebody who spent so much time and focus both in responsible investments and on the Just Transition Statement, and it's always a pleasure to have your inputs. Now, picking up on the theme of infrastructure investments, I want to redirect a question to Motlatsi. We've seen around the globe, infrastructure has been receiving unprecedented attention. As we speak, the capital in the United States is arm wrestling in terms of just how big the infrastructure program is going to be, anywhere from $1 trillion if the Republicans have their way to 4 or 5 trillion if Joe Biden has his way, with a bunch of other things chucked in between. Locally, we've seen the Presidential Office on Infrastructure Investment really trying to bring public-private partnerships together, and we've seen Regulation 28 changes or spoken about trying to encourage infrastructure investment and the public-private partnerships. Motlatsi, as somebody who is very close to impact funds and thinking about alternative investments, how are you seeing this landscape and this opportunity unfold, and what benefits does it bring to investors and its position into the future of portfolios?
Yes. Yeah, I think the first thing we need to acknowledge, Mike, and I guess you've touched on it, is the fact that as a country, there's a significant challenge when it comes to infrastructure. Our infrastructure investment has been lacking for many years. The infrastructure has not been maintained, and as a result, we're way behind where we should be, just in terms of functional infrastructure. The President's Office, as you mentioned, has been running some numbers just in terms of what the actual shortage is. And they've identified that in the immediate future, there's at least a shortage of infrastructure with a value of some 2.3 trillion rands that needs to be filled. And together as an industry with the office, we've been looking at projects that are or can be brought to a stage where they are bankable, where the private sector can come in and actually put in cash into this. And to date, we've identified some 273 projects which are at a stage where they can be bankable. And these will lead to a direct creation of some 1.8 million permanent jobs. These are just some of the benefits, but obviously there are other benefits which are a lot more significant, just in terms of improvement of quality of life of people, making accessible to people essential services, and that sort of thing. So infrastructure obviously plays a key role, not just in terms of generating return, or at least generating regular income, but it plays a significant role just in delivery of the social benefit and social impact on our communities. So from that perspective, it fits in naturally within our impact story and our impact thesis. If you consider that within our impact funds, we're looking to create positive impacts, both from a social perspective and from an environmental perspective. And infrastructure is obviously key in that. So we have built our infrastructure, our impact funds around infrastructure. So if you think about what I mentioned earlier on, that we've got our alternative energy fund, which is really built around renewable energy and alternative energy sources. We've got our social impact fund, which is also built around providing social infrastructure, which has a very direct and very impactful delivery on our communities. And then lastly, where we're looking at general infrastructure, which more or less plays a similar kind of role. So from that perspective about impacting people's lives and providing an essential services to make the economy work, infrastructure we think is right in square in that space. And that's why we are supporting it in such a significant way.
I mean, infrastructure is broad. And before I move on from you, Motlatsi, I just want to ask, in terms of the infrastructure landscape, where is the focus opportunities and where are the greatest opportunities for infrastructure? And where are you concentrating your efforts and why you've mentioned the diversified infrastructure, social infrastructure, alternative energy, but why those particular focus areas from an impact and infrastructure perspective?
Yes, they're driven by a number of factors, and just to highlight a few of those, the first one is obviously that it's availability of actual projects, right? In the sense that these are projects that are actually bankable. So from an investment perspective, we can quickly and easily get them through our process in the sense that it's easy to identify where the impact is. It's easy to see how we can actually allocate capital to them in a way that actually has the benefit that we're looking for. So those are quite easy. So if you look in the renewable space, in the renewable energy sector, for instance, that certainly ticks those boxes. So that's why not just ourselves, but also our competitors are so focused in that area and allocating so much capital to that. However, away from, I guess, the headline sectors, there are also quite a number of other areas where we are looking to make an impact on, right? So we've obviously mentioned student accommodation. We know obviously the shortage of student housing in the higher education sector. That's been well publicized. So we also are active in that space. We also know the challenges around water security within South Africa, right? We know the issues, for instance, just as an example, around the Vaal and what's happened around there. And this is not just obviously around Gauteng, but even in the Eastern Cape, the problems around water security and the provision of water are significant areas. And so that's where we are allocating, and we're looking to increase our allocation to that space. The other areas of interest are obviously also around the biodiversity in general. So we've come across a number of interesting projects that are around the Western Cape and around how the biodiversity environment there can be preserved and can be made available for the use of the community to benefit, both just from a social perspective, but also for creation of employment and preservation of our communities around there. So those are some of the other projects that are getting our attention, and we think that because these projects are driven not just from a financial return perspective, that we are looking at other metrics around what we need to deliver. They increase obviously the scope of things that we can look at, that we're not just being driven by the need to return financially to our investments, but we're also looking to grow our economies and play, I guess, our role in terms of the compact that investors or the business we have together with our communities and with government.
I mean, that's an important point. You're touching on the fact that you need diversification and you need to be discriminating around the type of investments, because impact funds, it's not donations. There's a real financial imperative behind it. And from a portfolio management perspective, you need the diversity to manage your risk, but also have the opportunities to focus investments and fine-tune them in terms of what you are trying to do. Thanks, Motlatsi. Before jumping to the other panelists, I just want to direct another question to Nicole, who's now had an opportunity to think and listen to some of the responses around alternative investments. But Nicole, what do you think the future of responsible investing is? How is it going to evolve? And in particular, what do you think the role is going to be when considering alternative assets?
I think there's a couple of really important trends when it comes to responsible investment. The first one, I think, is just the sheer extent of it and the expansive nature of responsible investment. So the PRI at the moment has almost 5,000 signatories. They represent more than half of the world's global institutional investment. So in no way is responsible investing or integrating ESG factors into your approach any kind of niche or unique or arcane way of investing anymore. So that's one thing that's really important in terms of the trend and how it's evolving, is that it's rapidly becoming the mainstream or traditional investing approach. And I think that's one thing that's really important to note. Other trends that we see are really around, I would say, active ownership or stewardship of assets. There's a growing understanding that, especially in smaller illiquid markets, to divest is not an option. It's not a logical or rational option in terms of what it does to the structure of your portfolio, but it also doesn't achieve what you're hoping to in terms of your responsibility or your sustainable investment objectives, right? All it does is, most of the time, create a vacuum for another less scrupulous investor to come in and carry on. And so there's an increasing emphasis on active ownership by investors. So on engaging with those assets, on working with them to transition, on saying, we want to stay invested. We want to really steward this into the new normal. Here are some of the things we think we'd like to see from you in the next couple of years. What does your research say? What is your plan? This push on TCFD-aligned reporting is massive. It's really a shift in the way we've been thinking about investment decision-making. It's not a focus on backward-looking information. It's less, we care less about what you've done and much more now about what is your plan, what is your strategy going forward, and we're letting that inform the way that we make investments and the way that we engage with those assets much more than past performance and past action, which is an exciting shift because, again, it just makes so much more sense. Coupled with this, this increased engagement and active ownership sort of approach is increased collaboration. And that's something we're seeing globally and also starting to see sort of flickers of in South Africa, which is this idea that, as investors, even as the biggest sort of asset owners in the world, we can't do this on our own. We want to be able to continue to generate return in 10, 20, 30, 50, 100 years from now. And that's not something we can make possible without collaborating, not only within our industry, with our peers, but also with policymakers and regulators, with civil society, with academia, to make sure that we can make informed decisions, that we've got the information that we need to actually take this agenda forward. So those are big trends that I think are happening. From the alternative space, it's really exciting to see increasing interest in maximizing, I suppose, the level of influence that comes with an alternatives approach, right? And that you usually have, because of this active ownership and stewardship push, you've usually got greater say. You could probably get a seat on a board, something like private equity. You can have a lot more influence. You're closer to the impact, which we've talked about, sort of the influence of that and how that's gaining momentum. So I wouldn't be surprised to see sort of a shift into increasingly alternative investments as a way to generate not only your financial return, but also this sort of stabilization or impact return that we're also looking for, and doing that in a collaborative way, because the alternative space also gives us so much opportunity for innovative finance mechanisms, blended finance. So I'm not a prophet, but I do think those are things that I wouldn't be very surprised to see in the next couple of years.
Thanks, Nicole. It's really an exciting place to be, and we really are on the lookout for creating a future that doesn't just benefit our investors, but benefits society at large. Early in the conversation, Mtlati touched on one of the other features of alternative investments, and that's around illiquidity. And there's this dynamic tension in the environment where there's a perspective that the longer-term views that you can take on investments, the better return you can get enhancements. But we live in the reality of an economy where there's massive unemployment, there's retrenchments, we've got open architecture retirement funds where there's a need for liquidity. So commonly, one of the more liquid alternative investment types is the hedge fund space. Can you just talk to us how you see the complementary nature between the hedge funds and some of the more unlisted private equity and illiquid assets that you do see?
Sure, Mac. So the hedge funds are the more liquid alternative strategy, and they should be seen as complementary to some of the less liquid private market type strategies. And this is complementary in terms of both liquidity as well as being able to access different risk premia than you would be able to access in your private market strategies. So in the hedge fund space, you're looking at being able to extract a premia from the increased volatility in markets often, and from a lot of the dislocations that you find as a result of mispricings between securities. So being able to harness some of those arbitrage opportunities that you're not naturally able to access through the private market strategies or any of the traditional investments.
When we think about alternative investments, we naturally think about the liquid alternatives, the private equity, the infrastructure, and we are trading into an illiquidity premium. What we sometimes forget when Mtlati spoke a little bit earlier about looking for yield enhancement and taking longer-term investment views, there is an opposing dynamic in the market, and that is with the member choice environment in retirement funds and a need for liquidity. There is, and just looking at the local economic circumstance where there's a lot of retrenchments, there is a definitive need for liquidity, and that often is a dynamic tension in the alternatives landscape. There is an alternative asset class that does have liquidity, and that can be used in a complementary way to the unlisted investments. And Kamini, as our hedge fund manager, earlier you spoke about some of the investment opportunities where you can pick the minds of your private equity colleagues in terms of what's happening when companies delist and come into the private markets. Can you maybe tell us the opportunity for hedge funds and how you see the complementary role of hedge funds in the alternatives complex?
So I think to your earlier point, Mike, the hedge funds are the more liquid alternative investment. So they are complementary to the less liquid private market type strategies. And that's complementary in terms of both liquidity and access to alternative risk premia. So it's a different set of risk premia that you are accessing through a hedge fund versus the private market strategies. So with a hedge fund investment, you're looking at accessing more of that volatility premium. So when you see this increased volatility in the markets, the hedge funds are able to trade more actively around the mispricings that are presented from that. Like you mentioned, the hedge funds are by nature more liquid because they invest in these more liquid counters, so either through your listed investments or your derivatives, but there is a lot more liquidity and price discovery in the instruments where they are trading. What we have seen, as I mentioned in the talk earlier, is that we've seen, in line with global markets, a shrinking exchange. So as more counters are delisting and you're seeing these greater mergers combining counters on the exchanges, a lot of these delistings are a function of private equity investments or private equity investors buying out those companies or taking them private. Not exclusively, but a lot of the delistings is as a function of that. Similarly, on the other side of that, you find that in an environment where we have low interest rates, there isn't a greater interest in your private debt, so debt financing over equity, and you can see that. So our private markets teams often are privy to private information in these transactions and on these companies, which we do not have access to. So there isn't quite that integration between the businesses in that sense. What is quite beneficial for us, though, is to understand some of those broader trends impacting markets and how those can play out in the listed space and where that can potentially provide opportunities for example, the hedge fund strategies going forward.
But it's a key point that you mentioned, that historically a lot of asset management and investment management firms have operated in silos, and more we've seen the benefit of integrating knowledge and sharing knowledge across different components. Now, hedge funds historically have had a little bit of a reputation of being a black box, and we've done a lot of work in terms of managing the cost of hedge funds and bringing transparency in terms of what's happening in hedge funds. The one question that clearly, and a theme that we're picking up in a lot of our other investments and in the unlisted alternatives in particular, is the role of ESG and responsible investing. So how does ESG and responsible investing work in the hedge fund space?
So ESG principles have formed part of the investment processes for these businesses for many years now. But what we've seen for a while is that there's been this focus on the governance side of the ESG equation. And that's as a function of the management teams being able to drive strategy in the businesses in which they invest. What we are seeing now coming out a lot more is that there's an increased focus on some of the environmental considerations in these businesses, as well as looking at whether RI policies and procedures are in place in those companies specifically. So I expect that we'll see a lot more of that start to play out as the disclosure becomes better, and as we see this focus on ESG continuing through the investments industry. The other thing that we are seeing in the fund managers is that they are trying to implement these RI policies or ensure that the RI policies are in place with their service providers as well. So trying to ensure that the value chain, if you like, has RI policies in place throughout.
I mean, so we can see in terms of the alternatives complex, there's a key role for the hedge funds in terms of providing liquidity. And I just want to take my next question to Rian. One of the criticisms, the expectations of private equity in the past has been very much around the space of longer term yield enhancements. And I know, Rian, you've been doing a lot of work in terms of how can you enhance the liquidity of private equity investments, and how is that landscape evolving, and how do we start creating those markets that you can give the benefit to investors, but within reason also allow them mechanisms to not be in permanent capital vehicles, to manage that tension as well.
Thanks, Mike. Yes, it's a very relevant question at this point in time, as you highlighted earlier, with what is happening in the broader economy. I think the first thing to appreciate is that these are long-term investments, and the typical life of a private equity fund is typically 10 years, and normally there are extensions as well of up to 2 to 3 years. And now that sounds very scary, but I think we need to keep in mind is that this is not, you don't pay all your money in a lump sum up front, and then that is locked up for a period of 10 to 12 years. So I think that's the first thing. It is that you make a commitment up front, and that is drawn over a period from the investor into and to be invested over a period of 5 to 6 years. I think the second point then to make is that you're also not only going to receive all of your money after 10 or 12 years. You are probably going to receive interim distributions, whether that is dividends, interest, or capital repayments. And every now and again, you might have an investment that was made earlier, and that will be liquidated or sold to a prospective buyer over a shorter time horizon. And there you will also return capital a lot quicker to the investors. So your weighted average holding period is not the scary 10 years. It is typically a 7-year holding period for those investments. But every now and again, there might be exogenous factors that give rise to a liquidity crunch, and investors may need to or want to have to access or sell of their interests in the private equity funds. In the old days, that wasn't necessarily very easy, because once you are in and you are committed, you are committed. And you had to find another buyer in order to take over your investments in these private equity funds. And that gave rise globally about 2-3 decades ago of what they call secondary funds. So where an investor wished to sell their interest to another existing investor or a new investor that wished to buy into these assets. So that is what we call a secondary purchase. So that is typically the easier way these days to return a lot of capital or liquidate a portion of your investment portfolio in a shorter space of time.
So what we really seen in the evolution of how alternative investments are playing out is how different types of alternative investments deal with different parts of the capital structure of a company, and also there's a wider array of investment opportunities and investment types. Now, just turning to Tsepo, as an analyst in the space that's really on the ground in terms of what's happening in the private equity and the alternative space, what trends are you starting to pick up, and how is it playing out in the alternatives landscape?
Thanks, Max. We're seeing a couple of trends happening in the market. I think the first one is we're seeing an increase in allocation by investors into private markets, internationally and locally. I think locally that's more to do with the changes in Reg 28, which is encouraging pension funds to increase their allocations into private markets. But I have to say that 2020 was a difficult year for fundraising, for fund managers. And yeah, it was a difficult year, and then we'll probably see a rebound. Actually, there is a rebound now happening into 2021. Another trend that has been quite interesting to see is just been the explosive growth of special purpose acquisition companies, or SPACs. They have raised, a lot of capital in 2020. It's been quite amazing. But time will tell whether this trend will continue or not. Another trend that's just been obviously just continuing is ESG. And in terms of ESG, we're seeing a lot of pressure from LPs, onto GPs to incorporate ESG principles in the investment process and in the investments. And this has led to greater transparency in ESG policies and performance. Another thing that we are seeing is that there's been some product proliferation in terms of investment managers, and then that's in two forms, really. That is through strategy, and then also in geography. When we talk about strategy, it's more if, a manager launches a new product that's different from their flagship fund. And then in terms of geography, that will be more where a manager launches a fund that's specific to one geography, or it's outside of their home market. So that's what we're seeing. What we're also seeing is in the secondaries market is an increase in GP-led secondaries. And this is where secondaries players and the GP can reconstitute an investment vehicle. And that allows the GP, to increase the ownership, the time of ownership in certain assets. And then it also provides liquidity for LPs to either to exit or to also stay in this new vehicle. Another trend that's also coming along is the rise in listed private equity funds. That's more internationally, and I mean that enables investors to get access to private equity without being committed into the normal private equity structure. We're also seeing some trends within our own portfolios. One of them is that we are seeing GPs coming to LPs and requesting extension to fund lives. This is mainly due to the impact of the COVID-19 lockdowns. We're also seeing that the managers are being very selective on what they're purchasing. They're not just going out for anything that is available, so they're being very selective. And lastly, we're seeing valuations return. And I think during the lockdown, valuations compressed, and that was mainly to do with the lockdowns, which hurts your maintainable EBITDA, and also your valuation multiples also compressed during that time.
I really enjoyed the panel discussions. Thank you, panelists. Thank you, Nicole, for joining us. But what I really hope that you can see is how dynamic the alternative investment landscape is, how integrated it is across different components of the capital structure and the different types of investment you can have, and how there really is thinking about trying to address some of the trends we've seen in the broader investment landscape. How do we think about liquidity? How do we think about new investment opportunities? How do we think about costs? And the one that really is front and center in all of our investment discussions more and more is responsible investment practices, and how we integrate ESG and how the team forms a cohesive unit, whether it's in the hedge fund space or the private equity space, that there's insights and unique abilities that can be shared across the skill base. I hope you as the audience have enjoyed the discussion as much as I have, and I thank the panelists for participating.
We hope that you thoroughly enjoyed the information, the knowledge, the insights, and even the videos that we shared with you today for day 2 of our conference. Tomorrow we wrap it up, and this time around, looking to explore and focus on multi-asset class solutions.